Old market milestones are revisited but don't hold. Coming up on the Moneyline Weekend Edition, has the summer rally come and gone?
This is the Moneyline Weekend Edition with Rhonda Schaffler.
Welcome back. The violent swings in the market have left investors looking for something to blame. One area that's taking some of the heat for the recent volatility, hedge funds. The industry boomed during the 90s, drawing not only attention but hundreds of billions of dollars in new money. In the last decade, hedge funds have exploded, with industry assets ballooning from $35 billion a decade ago to over $560 billion today. Joining us now is Charles Gradante, CEO of the Hennessy Group, a firm that tracks hedge funds and offers investment advice. Good to have you here. Thanks so much for being with us.
Great to be here.
And are you guys the people responsible for all the market's problems? That's the rap.
If you listen to what you see on TV and read in the papers, I guess we're the bad guys, but actually we're not. You know, hedge funds have about $583 billion under management, and globally we estimate there's about maybe $800 billion in assets, and the global market is $40 trillion market. So hedge funds are really a small player here, even when they are levered up, which is also an over-exaggeration as to what they do and how they do it. But that's something we'll get to, I'm sure, later.
Lots of blame about what the hedge funds have done in the down part of the market. In the last 20% move up in the last month. A lot of the hedge funds have been given credit for turning around, going the other side.
Yeah.
What's your guess?
Hedge funds, in general, are down for the year, 4 or 5%, which sort of indicates they're not making money in this down market. The interesting CTAs, who are not hedge funds, those are commodity trading advisors, are up 18%, and I feel that they're the tail wagging the dog, not hedge funds. They are shorting the market. They don't have to short futures on an uptick rule. And when we see the futures market lead the cash market, those are CTAs, not hedge funds.
Charles, there's been a huge growth in the number of hedge funds past few years. Mr. Vogel said at the end of the week that half of the mutual funds are going to have to go out of business. Now, are there that many smart guys that can really beat the market sufficiently? They deserve a 20% carry if they do it, or is there not going to be a huge shakeout in the hedge fund business?
I think you have a point, Vince. You know, there is a lot of money flowing into hedge funds, and you have the old 80-20 rule. 20% of the managers are really doing 80% of the solid performance. So I would agree with you there. But on the other hand, I don't believe that there's a bubble in hedge funds, which is a subject that comes up quite a bit. I think bubbles are created by items that have a bid-offer spread, like tulips, like stocks, like real estate. Hedge funds are not traded, so there's no bid-offer spread. Hedge funds are more like banks. If they take too much capital, they'll have a performance problem, but they won't implode.
Charles, let me just say, I've met you for the first time, seemed like a nice fellow, but I want to put you on the spot. What is the turnover rate of the average hedge fund? And why I'm asking that question is because on the margin, these funds, I think, can make a big difference in the volatility.
Turnover in terms of, it's, first of all, of the 500 and some odd billion in hedge funds, 2/3 are in long-short equity managers, and those managers are turning their portfolio over on average 3 times a year. Some as little as 1, and some as many as 6 to 12 times a year on portfolio.
Well, not to interrupt Bob's thought, but what's the average leverage that those funds
Good point.
would have?
The leverage right now is virtually nil. The average hedge fund portfolio is somewhere like 60% long, 40% cash, and about 40% short. So they have a net exposure of 20%, which accounts for why they're down 4% for the year. 20% net long on a 20% down market, you're down 4%. And they're sitting on cash. They're waiting for this market to show some more visibility. But once again, CTAs are up 18%. So if anyone is making money on the market going down, it's CTAs shorting futures. And interestingly enough is that the counterparty to the short future is often the investment bank, like Morgan Stanley or Goldman Sachs and other people that make markets in futures. They cannot find buyers for the other side of that short futures. So to hedge their balance sheet exposure, they short the cash market. And that's why we see a lot of shorting coming down in sell programs, many of which are caused by investment banks and also pension plans.
Well,
that have to rebalance their portfolio.
It sounds, with everything you're saying, that investors just better get used to volatility. With everyone in the market now and everyone having a certain strategy, there's always two sides of a trade.
Yes. Now let me do some mea culpa here. I mean, hedge funds, do create some volatility. They account for about 6% of the daily volume, maybe as much as 10%. Your biggest volume movers in the market are program traders, which are about 38%, and then you have pension and institutional money managers that are structured around a 60-40 split between equities and bonds with 70-30. And anytime you have a bond rally where the bond portion of their portfolio goes from 30% to 40%, they have to rebalance. And that's where program trading comes in. And so you have this big influx of either buy programs or sell programs, creating volatility in the marketplace, what appears to be hedge funds, because everybody thinks that hedge funds are the only people out there that can sell, short and
Charles Gradante, clearing things up for us. Thanks so much for coming on and
Thank you.
explaining it's not just those hedge funds.